The trend is your friend, and if you can figure out which direction the market wants to go, finding great entries becomes so much easier. And that's exactly why I'm able to find setups like these almost all day long. I get in, I get out, and I'm done usually in just a few minutes, usually with a solid profit. So in this video, I'm going to show you a few key things. I want to show you how to spot the current trend, where to look for entries, and most importantly, how to actually profit from this information that you will discover inside this video. So let's start off by actually discovering what a trend really is. And when I say trend, I don't mean three candles in a row pointing the same way. It's not what I mean by trend. A trend is the market basically showing you its hand. Okay, so it's consistent behavior in one direction. Why? And the important thing is, other traders need to accept this information. And there are really three types of trends. You either have an uptrend, you have a downtrend, or you have a balanced day. So not really a trend. In an uptrend, as the name says, you'll see higher highs, higher lows, and most importantly, the market accepting these higher prices. And that the word accepting is huge, and I'll come back to that in just a minute. Now, in a downtrend, it's the exact opposite, all right? So you see lower lows, lower highs, and the market just accepting lower prices. Now, in a balanced day, the market is basically saying, well, these prices here are fine, no need to move higher or lower. So you'll see the market rotate back and forth in a range without really that much directional push. Okay. Now, here's the key. You have to trade with the trend, not against it. It's kind of like a river. Okay. You can swim against the current if you want, sure. I mean, you use up all of your energy, you'll be exhausted, and most of the time, you won't even make it to where you're trying to go. Or you can just swim with the current. You know, you let the environment do the work and you get to your destination much quicker, which in trading is obviously the destination of making money and making some profits. Now, knowing that, okay, what is a trend and we should be trading with a trend, not against it, how can we actually identify the trend in the market at any given time once you actually open up your laptop and you want to place some trades? Now, there's a bunch of ways that people try to figure out where to or how to identify the trend. Some traders will draw these funky trend lines here all over their charts. Others usually rely on indicators that supposedly and magically tell you which way the market is trending. Now, the problem with all of that is it's not really reliable because it's not based on the full truth, the entire truth. You see, most indicators and these trend lines are only looking at time and price. Okay, so if price keeps going up while time passes, then sure, they just call it an uptrend. Okay, and sometimes that works. But here's where it doesn't work. Well, they usually completely ignore one of the biggest factors in the market, which is volume. And I don't mean volume over time, like those little bars at the bottom of your chart here. I'm talking about volume over price. Big difference. Volume over price tells us how many contracts were traded at each individual price level, for example, throughout the current day. Now that's powerful information because it shows us which prices are actually being accepted by the market. There we have the word again. And which prices are being rejected and not accepted, obviously. And remember, the market has one main goal. And that's the North Star goal of the entire market. The market wants to transact as many contracts as possible throughout any given day. But here's the thing. It can only do so at price levels that are being accepted. Exactly. So if a price level isn't accepted, the market simply moves away from that price level and goes looking for another level where it can do more business, where it can transact more contracts. So let's break this down with an example. Imagine we are in an uptrend, okay? So in the morning, the market is happily transacting at these lower prices here. So these prices are being accepted. But then some news drop or whatever happens throughout the day. And suddenly traders, institutions, big banks, hedge funds, they decide that those prices don't really make sense anymore because of the news that just happened. So buyers step in and they say, nope, the market should transact at higher prices. And just like that, the market stops accepting those earlier prices here and starts pushing upward. And it'll keep climbing until it finds a new area. So at higher prices, obviously, where traders are once again willing to do business and build new acceptance. Okay. And that's why trends happen. Volume basically shows us which prices are being accepted and which ones get left behind throughout any given day. And to actually read this information as clearly as possible, we use something called the volume profile. Now, if we dive deeper into the volume profile, there's so many interesting things about it. So let's actually dive a little bit deeper because this is valuable information for you. I can assure you that. So instead of looking at volume over time, like those little bars here down below your chart, the volume profile stacks that information on the side, but over price. So it's not using time, it's using price as one of these parameters to build this chart. And this does something very interesting for us. It basically highlights where the market accepts certain prices and where the market rejects other prices. So these big fat areas here on the profile, that's where the market was happy, where buyers and sellers agreed, yeah, that's a fair price. That's a price that is being accepted right now. And these thin areas, these low volume areas, high volume areas, low volume areas, that's where the market quickly passed through or rejected because it didn't like those prices. Those prices are not being accepted. They're being rejected, okay? And this is why I always like to say, well, the price can lie. Sure, the price can go up. But if there's not that much volume, there's no real interest in trading at those higher prices. And we can see this using the volume profile because volume doesn't lie. Price can lie, but volume doesn't. So the price can spike, it can chop around, it can fake you out. And I'm sure if you've traded before, this has happened to you many times. But volume shows you where real traders actually put their money to work. And when you learn to read the volume profile, it's kind of like seeing the market's playbook just in real time, obviously. So there's four day types, I'm sorry, that you should know. And this is where it gets really fun because once you understand this, you can kind of predict what the market is doing next. So if you can watch how the volume profile develops throughout the day, you will notice it tends to form certain shapes. And these shapes actually tell you a lot about the type of day that we're in and where the best opportunities are for that current day. So the first day shape is basically a D shape. It's a balanced day. So this is, I would say, the most common day shape, and it just looks like a capital D, as you can see right here. And what it means is, well, it means that most of the trading is happening right here in the middle of this range with less trading at the top and at the bottom. And basically the market found a fair price and just rotated back and forth around it throughout the entire day. So we don't see strong push higher and no really any bearish movements to the lower end of this chart. And on days like this, the market is just simply balanced, and the best opportunities here usually come from trading low, or placing a short trade here at these higher levels and placing a long trade here at these lower prices, always targeting back towards the middle. Okay, but we'll get into more detail in just a second about finding good entries, obviously. Then we have the P-shape day, right? Now, the P-shape day is pretty easy to spot, actually. So it's very thin at the bottom and quite thick in terms of volume at the top. And this tells us that the market is now accepting higher prices. It's not accepting lower prices, but now as we transact higher, and higher, well, buyers stepped in, sellers stepped in, people are accepting, traders are accepting these higher levels, meaning the market is very bullish. And that means you only want to look for long trades throughout a P-shaped day. Now, then you also have the small B shape, which is basically the opposite. It just looks like a lowercase b. So it's very, very thin at the top and very thick at the bottom in terms of the volume profile. And this just shows us that the market did a lot of business at very little business at higher prices, then dropped lower, and it really accepted the prices down below. And that means sellers are in control and the market is just interested in exploring lower prices. And what do we look for? Well, we only look for short trades. Where exactly? I'll get into that in just a second. After I showed you the last volume profile, the last shape, which is basically a capital B, so a B-shaped day. So you see volume build at the top, but also volume build at the bottom, and just a very thin spot in the middle, okay? And what that tells us is that the market was interested in both higher and lower prices, but it didn't really care much about this middle ground here. So this type of profile often shows up when the market expands its range, testing both sides, obviously. And if, for example, the market traded quite a bit of volume in the morning session at these lower prices here, but then it expanded to these higher prices, traded some volume, and actually liked those prices, accepted those prices, then we get this capital B here. So we previously accepted lower prices, but now we also accept higher prices. So overall, that means, okay, now we should be able to profit from long trades, from long entries. This could also be the opposite, so the market accepting higher prices in the beginning and then accepting lower prices throughout the day, and then you would obviously only look for short trades. Okay, so now that we got this theoretic side out of the way, let's actually look at how we can use the volume profile and those day types that we just covered, not only to find great entries, but also to find great exits for our trades. And like I said earlier, we only want to trade with the trend, not against it, okay? So for example, let's look at yesterday. We had a pretty balanced day. It was a clean D-shaped profile, and that means that most of the trading was happening right here in the middle of this range, right? And in that type of environment in general, I'm looking for short entries up here at the low volume nodes above the range, and for long entries at the low volume nodes below the range. Pretty simple, right? Now, there's one caveat to that. One thing that's very important that you also need to factor in. You see that the overall volume, where is the overall volume building compared to the previous day? So in this example here, yesterday we traded higher and most of the volume was up here. But today the market is trading below that range. And it's telling us that lower prices are starting to get accepted compared to last day's trading. And if the market is accepting lower prices, I would much rather be looking for shorts at the higher levels here instead of trying to force long entries here at the bottom with the risk of getting stopped out because the market is accepting lower prices. All right. So now that we know that we're leaning short, the next question is, okay, how do we actually time the right entry? Okay. And one common entry signal, it's not my personal favorite, but it does work. No guarantees, obviously. It's what's called stop fishing. Okay, and you'll recognize this when you see candles with long wicks, like you see here. Basically, a hammer-shaped candle. What that usually means is that stops were fished, they were triggered, okay? So retail traders got flushed out, and then bigger players started to step in and push the market right back to the level of interest. And they do that to build up some more positions, okay? To get more contracts into the market. So they basically take advantage of these retail traders up here. So if you see that type of candle at one of your levels, it can definitely be a valid entry signal for one of your trades. Now, personally though, I prefer using something called the order flow. I use a software tool called Bookmap for that, because with order flow, you can actually see what's happening inside those candles. So you get to see aggressive buyers or if aggressive sellers are stepping in, where traders are getting trapped. And this gives you just so much It just gives you a very clear picture of what's actually happening inside those markets. So you can look inside those candles instead of just relying on any outside information or just candlestick patterns. But that's a bit too much for this video, but we're going to cover this in another video. So make sure to subscribe to the channel, and then you will see those videos once I publish them. All right, so you've got your potential entry right here, but where do you want to get out? Well, like I said, I'm not going too deep here, because even just posting entire video about where to find the perfect entry, that's a whole video. It can be hours just on its own. I just want to show you a small and simple framework here that you can use right away and actually time your entries quite well, to be fair. Now, in order to do that, you need to remember high volume nodes are areas where the market accepts price, right? And once the market accepts a certain price, your advantage is usually gone. And here's an easy way to think about it. Imagine a car dealer buying and selling trucks, okay? So if the average price of a Ford F-150 is $50,000 and he buys one for $49,000, well, he doesn't really have a huge edge, right? His margin is only $1,000. No real advantage for him, right? But if he can buy the same truck at $40,000, he now has a massive advantage, right? So he buys low and sells at accepted prices. He buys at rejected prices and sells at accepted prices. If you buy at accepted prices and you want to sell at accepted prices, no real advantage here. So trading kind of works the same way. You want to enter at prices that are not being accepted, so right here, and then exit as the market moves back into areas where price is being accepted. Sure, you can wait until the price goes into a price level that is not accepted as well. However, the chances of that happening are much slimmer compared to you just waiting for the market to go back to accepted prices, okay? And accepted prices are usually just high volume nodes, as the volume profile dictates. This can be the volume point of control or just any of these high volume nodes right here. And one thing that you need to look out for is if price struggles to get through one of these levels, that's usually, not always, usually a pretty good spot to take your profits. So that is everything you need to know about trend. How to identify the trend, how to trade with the trend, how to find good entries using trend, and where to find good and solid exits using the trend and the volume profile, obviously. It's super simple. Try this out on your own, and you will notice that this somehow magically seems to work, okay? So if you have any questions about this, let me know in the comments down below. Otherwise, make sure to subscribe to this channel, as I will release more and more videos coming up in the next coming days, weeks, and months. And without further ado, I will most likely see you later or tomorrow for another live trading session on my channel. So make sure to look out for that as well. And I wish you a great day, and I'll see you in the next video. Bye-bye.